Good afternoon, everybody. We change a little bit the focus from banks to insurance, but you will see that there are a lot of commonalities, a lot of things that are equivalent. If you could put my slides, just maybe 2 words. Insurance is a very old industry and actually a quite successful one along the years. I called my small intervention a change of paradigm because insurance for a very, very long time was managed around the cash flows. How much premium you got and how much claims you paid. And a company was considered to be solvent if what they called the combined ratio, which was loss plus expenses divided by premium, was smaller than 1. So as long as it was smaller than 1, the company was solvent. You had some slightly different performance measure for life insurance, but essentially that was a cash flow type of measurement. So it was essentially an accounting performance measure of the company. With the advent of risk-based solvency, but not only that, also a pressure from the financial market and the capital, the question becomes, if you have to publish your risk, the question becomes, if you assess quantitatively the risk of the company, here for instance is a picture of the risk-based solvency in the world at the moment, and you see that most of the countries that have a good functioning insurance system are more or less in a risk-based solvency regulation, where companies are required to publish their risk in terms of the capital that they need to support it. As soon as you do this, the question becomes very natural to ask, what performance? So you are showing me the risk you have. Do you perform against this risk? It's not enough to say, I'm making some bit of money above the losses and the expenses I pay, but is this the money that I'm making really supporting what I'm doing? To give you an extreme example of that, there was a company called National Indemnity that belonged to Warren Buffett that was doing, over the years, an average of 17% return on equity. And then came 2005 with the big hurricanes in the US, in New Orleans, Katrina, Rita, Wilma. And when you made the average performance of this company over all the years, including this one, the return on equity dropped to 5%. So one single big event and the profit of the company goes down. So what is the relation between the risk you are taking and the performance you do is not a small question. And so you see slowly the companies going from combined ratio, technical profitability, which you will always see in the balance sheet, to return on equity, return on risk-adjusted capital. So slowly the company have to cope with this problem. They cannot simply look at their cash flows. Capital in insurance, but even more than in bank, is used to guarantee that they will pay the policyholder up to a very high probability. So it is the way to assess the risk of the company, and it has become a monetary value. 10 years ago, you'd never ask an insurance about its solvency ratio. And nowadays, all bank analysts, when you go to a bank, to an investor conference, they will ask for the solvency ratio of the company, and if the solvency ratio moved from 2.2 to 2.1, they will ask, oh, why? And you see also that it is also becoming a marketing tool. And what is this solvency ratio? Is basically the ratio between the available capital of the company over the required capital, the SCR of Solvency II. So we are moving to a new world of assessing the risk, and also from the client point of view. I made an experiment a few months ago. I asked a few students in the room, I showed them two companies. I said, you have to buy a life insurance. And this life insurance premium is like this. And I put also the solvency ratio of the two companies. And out of 5 students, 4 chose the company that had the higher solvency ratio, even if the premium was slightly higher. So it is really a change of paradigm. Now we move from a world where we were looking at how much money you made above what you paid to do you make enough money for the risk you take? So it becomes a risk-return problem. Now, how do we cope with that? We need to find a way to compute this risk-adjusted capital. And that's where comes the internal model. And I thought I would talk to you a little bit about the internal model of insurance, but because it's quite different from the internal model that you have in bank that is required for the insurance. Insurance, we usually look at 4 big type of risk. We have what we call the underwriting risk, which is the risk of the policies that we sell. And then you have the investment risk, which is the money that you have to invest to guarantee payment, credit risk, and of course operational risk like in banks. Now, what is an internal model? You all start from the balance sheet, and now it is going to be an economic balance sheet. So a balance sheet that you translate from the accounting rules to an economic view, where you have on one side your asset, on the other side your liability. The difference between the two is what we call our own fund, or the available capital of the company. All of these different items in the balance sheet, they are subject to risks. So you can model this here. Here I put the risk for the market risk, but we can move to the risk on both sides of the balance sheet. For instance, the yield curve will affect the asset and the liabilities. And you have, of course, the underwriting risk. So once you have modeled all of these, you can start producing scenarios. And usually, for instance, in the model we developed that score, it was 100,000 scenario. And the outcome of this 100,000 scenario will be basically this own fund. So you have this own fund that will be distributed for the next year. And Solvency II will tell you, look at the VaR at 99.5%, and this is your solvency capital requirement. So that's how the company determines the risk. Of course, I'm not going to talk about how we get to this risk, but that's the idea. So now, those internal models, they don't come out of the blue. It's not because the regulator asked for it. By the way, the company I worked for, we started doing internal model in 2003. And I will show you why. Swiss Re, which has the oldest model in insurance, they started in 1993, a long time ago. So those internal models, in fact, the first people who started to think about, for the business, to model the risk were the life actuaries in the 1860s when they were doing mortality tables. The idea was you look at one risk. And then came somebody that actually came from Italy, De Finetti, who was the first actuary that thought, okay, if we put the risk together, we will get diversification. By the way, he found Markowitz 10 years before Markowitz. But it was for insurance. And so this is essentially, you will protect the value of your company if you diversify your risk. And then came, in the late 90s, the solvency regulation, risk-based solvency, so you want to assess the total risk of the company. This is what I would call the third generation of model. But we are now in the insurance industry, particularly in the reinsurance industry, in what we call the fourth generation of model, where the model is not only here to look at the risk, but also to create value for the company. And how do you create value? Is because you can model the whole distribution. So you can ask, for instance, the question, what is the probability that I will meet my target next year? And what is the probability that I will miss my target? Internal models, and this is a big debate that we see in banks, but it's also true in insurance, you have to start from the reality. And I like to divide this in three points. It's a simplification of reality, and it will always be a simplification of reality. That means that we have to look at the assumption we use, the data we will use to follow the assumption, the methodology that we work with. And all of this would have to be validated in an internal model. But this is not all. Today, to cope with this, we need to industrialize. At SCORE, we have about 2,000 risks in the model. So imagine all the data that you have to carry to get this into the internal model. And industrialization means processes, implementation framework, conceptual framework, and the regulator look at all of this. So it all starts, and we have had Aldo telling us so, it all starts at the board of directors to decide what kind of risk appetite the company wants. And what I put here is basically the results that you get from the internal model of SCORE. It's a cumulative probability distribution in a log scale put upside down. So you have the probability here and the X here. And what you see on these two curves, if you change your expected profit, so the blue one was the expected profit that came out of the internal model. If you make a smaller expected profit, you'll see the risk decreases of the company. So you have a direct relation between risk and return in the company. Consequence for the company, and I will end up with that. Data have a very high value. And you see company investing more and more money in data. It's not only the GAFAs, but also the AXA, the Allianz, or the reinsurer, to treat those data in a good way. I think despite all the criticisms that are put on quantitative method, they are here to stay. And they're here to stay because risk in insurance, as actually I think in the financial system, have become more extreme. And they've become more extreme not because in general the risks are more extreme, but because there are more people that are insured and people live in cities. So they are more concentrated. So when a big catastrophe hits, if you have an earthquake in the desert, it doesn't matter. If you have an earthquake in Los Angeles, it will matter much more. So those quantitative methods are here to stay. Risk management, and I was happy to hear that from Giuseppe before, is changing, and it's changing also in insurance. The CRO of an insurance company usually reported to the CFO of the company. Nowadays, more and more the CRO reports directly to the CEO of the company. He's not anymore the person that puts limits, that forbid business to be done, but is a business optimizer. Because if you want to have a good relation between risk and return, you have to make sure that your portfolio is well diversified. And I think we still need to make progress. And that is back to your system story. Between the implication of risk management to individual risks, the link between societal risk and individual risk. And here there are many questions open, and I hope we'll treat some of them. Thank you very much.